My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you, so call me at 1-800-743-CNBC or tweet me at Jim Cramer. This weekend, I did something some would say is ill-advised, but not from the town I am from. Yet, basking in the glow of an easy Philadelphia Eagles victory, I decided to take on a number of Twitter followers who insist that any rally from these levels is entirely phony. A move based on easy money from the Federal Reserve and a gigantic budget deficit. Therefore, they say it's all false. That's done badly. I read all these thoughtful 280 character or less arguments / Jeremiads, and they all have one thing in common. They hate the market and see it as a gigantic house of cards that's waiting to collapse. Even if you're not so hot today, the Dow lost 96 points. It was up a lot for most of the day. Well, some of it. The S&P shed 0.45%. NASDAQ dipped 0.33%. There's one huge problem with this worldview. History. Look at this. I got in this business in the fall of 1981 with the S&P trading at 120. 120. It's now at 2,938. The Dow was at 856. It's now at 26,478. If this isn't dispositive, I don't know what is. Now, I know if you're a short seller, it seems unfair that there could be a moment where the Fed's propping things up and there's a gigantic budget deficit, perhaps with a liquidity bubble because interest rates are so low. But that's just not how it works, people. The market's not perfect. Often it doesn't even make sense. You don't have to like it. But trying to fight it every step of the way? Well, look at this. It's cost you a fortune. Yet on Twitter, it's like I came in right here and everybody else, well, they've lost money. They have the chart upside down. For better or worse, certainly better there. For better or worse, stocks have been a great long-term investment for my whole investing career. Is that because I've just got lucky? I don't know. Isn't that a long period of time? Isn't it? First of all, because we've had decades of growth, we've had decades of progress. This isn't always the easiest thing to measure. Progress is so ethereal. Think about how much has changed, though, in the last 38 years. Personal computers, the internet, now the cloud. Material perspective, things are a lot better than they used to be. Second, while things have deteriorated over the past year, we're not in the kind of horrendous moment where we need to make wholesale changes in our portfolios, contrary to what you hear from many of the bears. Remember, it was only 11 years ago that our whole financial system melted down and our country was on the precipice. The weakness brought down Washington Mutual, General Motors, Fannie Mae, Freddie Mac, AIG, Bear Stearns, Lehman Brothers, almost destroyed GE. It was the worst period for our economy since the Great Depression. The systemic risk was off the charts. But what happened? Did the country fall apart? No. The center held. Why? Well, because the Federal Reserve made it so the center held by taking aggressive action right there. I don't rarely care how it was saved. Enough with the purity. What matters was that it was saved. I think if we made it through the Great Recession, we're certainly going to make it through a garden variety slowdown like we might be experiencing now. Third, we underestimated America's incredible resource wealth. No one ever talks about this. Our country's awash in oil and natural gas. That means we have cheap power. It means we've got great manufacturing capabilities. It's huge for the economy. While the trade war with China may be hurting us a bit, well, it's not like we import necessities from the Chinese. We're not hostage to them, other than our own minds. Okay. Fourth, our educational system is far from perfect, but it's created a tremendous number of entrepreneurs who have in turn created a tremendous number of enterprises that are hard to duplicate, and we have more upward mobility in this country than in any other in the world. Our legal system is a free market paradise. Our deep capital markets can provide an enormous amount of liquidity, although right now we've been glutted on new IPOs, and the last thing we need is more deals. Just say no to the IPO. Just say no to the IPO. Finally, there are the companies themselves. Whenever I see people bashing the stock market, they're almost always talking about the broader political scene. They're worried about Trump's bullying the Fed, or the Fed creating the illusion of sanity where none exists, or easy money simply make it so the stock market's the only game in town. But given that easy money is here for the foreseeable future, that seems like a silly thing to worry about. And stocks aren't the only game in town. Bonds have been incredible performers during this period, even if they no longer give you much in the way of income. So I think what the bears really miss is that it's not about the big picture. That's hedge fund speak. That's media who hasn't done homework speak. It's not about the macro. It's about the micro. See, underneath all these baskets that people have created needlessly in order to generate a huge number of fees, underneath that, stocks represent actual companies. And those companies can produce solid returns, even if the averages go down. I almost feel silly pointing this out, but in an era where everyone's worshiping at the altar of index funds, maybe you need a little reminder that individual stocks can give you individual performance, either through dividends or through share appreciation, or both. Let me give you an obvious examples, right in your, plain as day, right in your face. Apple. Yep. When Tim Cook took over as CEO in August of 2011, Apple was trading at $53. Now it's at $227, and that's not including all the money they paid you in dividends along the way. Now, I know many people who fought Apple every step. They believe the company is too dependent on its cell phone business, and its phones aren't much better than the competition, so the earnings have to come down. That's been the knock on Apple for years. I think it's just plain wrong. Not only is the iPhone better, more importantly, it's so popular that there's a whole ecosystem of AirPods and watches and pay-for subscription services that have turned Apple into much more than a handset maker. This service revenue stream will make their earnings far less episodic, and that will make the stock go higher still. Wall Street always pays more for sticky, consistent numbers than for the cyclical boom and bust numbers. And I've got to tell you, this Apple, the 11 consistently, someone must have downgraded Apple. It's trading down after the close. Oh, bore me. Anyway, now maybe you think that's all financial ledger to men, everything that I said. Maybe you want to Google ledger to men. Who cares whether the numbers are sticky or episodic? Aren't you basically paying more money for the same earnings stream? No! The market values consistency. You pay more for consistent numbers. This is not unique to Apple. Why do I bring this up? Well, I bring it up in part because Tim Cook is chronically underrated. The man never gets the respect he deserves. But mainly I mention Apple because it doesn't fit the profile of what these bears keep talking about and complaining about. Apple's value isn't being created by the Fed's easy money policies. It's not an unintended consequence of rate cuts to the budget deficit. Apple's simply a company that has made huge profits, and it's redeploying them to keep growing its business while compensating shareholders with dividends. I mean, that's what owning a stock is about. In other words, Apple's proof positive that you shouldn't view the whole stock market as one big, undifferentiated blob like a soybean basket or like corn. All stocks are not created equal. Some are a lot more equal than others. That should be self-evident. And there are hundreds of stocks that have good stories. Believe me, I know them. The bottom line, when someone tells you that the whole market is rigged to go higher by the Fed, tune them out. These people come out of the woodwork every time the Fed cuts interest rates. I've been hearing the same nonsense. When? Since 1981. And you know what? Judging by the numbers I gave you, it's been wrong every step of the way. That matters. Claire in New York. Claire.
Hi, Mr. Cramer. Thank you for giving me the tools and confidence to start trading again after 20 years.
There you go. I love that. Thank you.
Thank you. I broke a big rule, though. I bought Cisco 19 years ago at 57 and held. I'm looking for growth. Should I sell it?
I think that Chuck Robbins is doing a great job. The last quarter wasn't nearly as bad as people thought. I think it's a terrific opportunity to buy it here. Do I know this next quarter is going to be a blowout? No, but you get a great yield. It's got a great business plan. It's doing a lot of terrific things, and it is so inexpensive that I want you to stick with it. All right, the market's not perfect, but fighting it incessantly, it's been a fool's game. And there's evidence to support that. Just look at the value companies that they create every day. Look at our nation's abundant natural resources, our country's progress over the years. This moment is actually better than you think. Well, Mad Money tonight. You know I'm always looking for a bargain. Tonight I'm buying Costco after earnings. They've changed the way we shop, so it's time to buy in bulk. And investors of Cedar Fair might feel like they're on a roller coaster if the company turned down Six Flags acquisition offer. So what should be your next move when it comes to amusement park operators? Buckle up, and I'm giving you my take. And Ring Central jumped to a record high on Friday after announcing a deal with an old-school telecom equipment player, Avaya. Is it worth considering even up here? I've got the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.